Welcome to Taxes Made Simple. I'm your host, Karlton Dennis, and in today's video, I want to go over the 5 most missed tax deductions for 2023. The reason why I'm putting this video together is because many entrepreneurs, when I say many, at least 67% of the entrepreneurs that came to my office are on extension right now. You might be wondering, are they on extension because they're afraid to file the returns? They're not afraid to pay their taxes, but they're trying to figure out how to avoid paying taxes. So they're going on extension to give themselves more time. But I want to teach you the 5 strategies that I noticed that they are leaving off of their tax returns. And with a little bit of consulting, we've been able to guide them in order to save money on their taxes. So if this is you, buckle up. I'm going to teach you the 5 most overlooked tax strategies for 2023 that can position you to be able to save money on your 2022 tax returns if you're on extension. Without further ado, let's dive in. All right, guys, I got to kick this video off by talking about being proactive. You see, most business owners or most W-2 taxpayers, they're typically so focused on making revenue and making money that they forget to actually do their tax planning until like December or even in January, February, March, and April. But if you're watching this video, I want you to know something. You have time right now to figure out how to reduce your taxes for 2023 and figure out what you can do to try to mitigate your tax liability if you're on extension for 2022. But here's the thing. If you are not working with a tax professional that's teaching you strategies and you're just working with a CPA that files a tax return, do not get upset that some of these strategies that I'm about to explain to you are not offered by your CPA or offered by your accounting firm.
Don't worry, we're gonna figure this out.
I've spent years, and when I talk about years, I mean physical years studying the tax code, monotonous training over and over again, reading things to make sure I understand it. And then we bring that to my office and then we implement those strategies after we have fully understand the tax code. So this has taken years of study to be able to come up with these 5 strategies that I know will benefit you on your 2022 tax returns if you're on extension, or for 2023 if you're kicking off a great year and making good income. Now, the number 1 tax deduction that we see that's missed is taking depreciation on vehicles. And you might be wondering, Karlton, how could somebody possibly miss taking depreciation on a vehicle? Let me explain the case. You see, there's 2 different ways in which you can write off a car on your tax returns. You can choose to take actual expenses. Actual expenses is probably what you think about when you hear the word, the car payment, the car insurance, the gas, the tires, any actual expenses that you're having to operate that car. But then there's another method that you can take called mileage. Mileage allows for you to take over 62.5 cents per every single mile as a tax deduction. I'll be honest with you. Most taxpayers who are driving a lot, Uber, Lyft drivers, truck drivers, they're typically taking mileage. People who are more, work from home environment, business owners, they will take the actual expense. But the one deduction that is typically missed on the tax return, at least what I see from when taxpayers come from another office to mine, is they forget to claim depreciation on the vehicle that they purchased. So the IRS has this rule where you're allowed to claim depreciation on a vehicle if you purchase the car and you're using the vehicle for more than 50% business. This will allow for you to be able to write off the vehicle's purchase price. But the thing I want you to understand is that most business owners are tracking their monthly payments that they're paying for their car. They're tracking their car insurance. They're even tracking the amount of gas that they're spending. But they forget to sit down with their tax professional and make sure that their CPA or whoever is filing the return is taking depreciation on their automobile. You see, for the last year of 2022, you would have been able to claim up to $19,200 of depreciation if you had a vehicle that you purchased and placed into business service. And then if you were to claim bonus depreciation on a car that weighs over 6,000 pounds, in 2022, you can write off the entire purchase price. Some of you guys were aware, if you follow me on Instagram, that I purchased a Lamborghini Urus last year. That vehicle is 100% business use. We wrote off the entire purchase price because I took delivery of that vehicle prior to December 31st. If you're somebody that's watching this right now and you're thinking, I'm on extension, I want to save the most amount of money possible, then I would encourage you to look at this depreciation strategy. Most CPAs forget to calculate depreciation because it takes a little bit more time to do. But if you're somebody that wants to save money, you'll make sure that you're either taking actual mileage plus depreciation in combination with your actual or in combination with your mileage. This happens to be the number 1 most missed tax deduction by new entrepreneurs. The number 2 most missed tax deduction is taking personal payroll. Now, I know this might sound a little bit weird that people would forget to pay themselves, but it's not transferring money out of your business bank account that I'm talking about. The type of payroll that I'm talking about is when you have finally made the decision to make your S election from your LLC to the S corporation because your business profits are over 50 grand, but you forget to take the deduction for paying yourself from your own S corporation. You see, many S corporation owners get to benefit from the flow through taxation that LLC owners have, but they have some additional rules to follow. And one of the most important rules to follow when you're a S corporation owner is to make sure that you're taking an owner's salary. An owner's salary, also coined as a reasonable compensation, is the percentage of business profits that you're able to distribute to yourself in the form of a W-2 salary. Now, although you will pay payroll taxes on the amount of money that you're paying yourself personally, it still makes sense to look at taking personal payroll for your S corporation. The reason why it makes sense to take personal payroll for your S corp is because although you're paying into payroll taxes, the amount of money you pay yourself is a tax deduction to your S corp, which could end up saving you more money than it costs to pay into payroll taxes. The reason why this is the case is because a part of the Tax Cuts Jobs Act of 2017, the IRS and the government decided to implement the Qualified Business Income Deduction, or QBI for short. The QBI is a 20% deduction on business profits up to a certain dollar amount. So if you're an S corporation owner, you can receive a 20% deduction on your business's profits outside of what you've already paid yourself W-2 salary. This only applies to certain business owners who can qualify to take the QBI, but this is another important reason why you should always consider taking payroll if you're an S corporation. Many S corporation owners switch over to an S corp and they believe they're saving themselves money in taxes because they're no longer paying self-employment. But the one thing that they fail to do is they fail to go ahead and process their own W-2 payroll. I don't want you to make this mistake. If we are already past the year of 2022, which means that you're on extension and you forgot to take payroll, you can look at taking a late payroll, but you're going to pay penalty and interest. So someone should calculate, what is that late penalty and interest fee going to be? Do the benefits outweigh the cost of you placing yourself on payroll late to make sure that you're receiving the deduction and you're maximizing your QBI? This is a calculation that should be done prior to you filing your tax returns that can save you money. The second most missed tax deduction is forgetting to take personal payroll when you're an S corporation owner. All right, guys, we're starting to heat up. Let's jump into the third most overlooked tax deduction by new business owners. It's the Augusta Rule, aka Code Section 280A. And this is a tax code that you might want to look up and do some research on. Code Section 280A allows for a business owner, yes, I said it, a business owner, to rent out their home to their corporation for up to 14 days. Many of my new S corporation owners are so surprised by this strategy. They're actually so happy to figure out that the IRS created a deduction that allows for them to write off their house to their business and charge rent for it.
This is interesting.
This is a great deduction because most people are living in a home that are self-employed and they want to be able to get more than just the home office deduction. Well, look no further than the Augusta Rule. This will allow for you to rent your entire home, not just the portion of your home, to your corporation for up to 14 days. But here's the thing. What if you're on extension? What if you're just now finding out about the Augusta Rule? Is there a way in which you can go back into the year of 2022 where you might have already conducted business meetings in your house and categorize some of those business meetings as a part of the Augusta Rule strategy? What that also means is you might want to look at some of the distributions that you took out of your S corporation and look to recategorize some of those distributions as rent if you indeed followed the tax code the way it was meant to be followed. You utilize time in your home to conduct meetings or put on events, and this allows for you to be able to rent that space tax-free based on what you're able to charge. One of the most important steps to the Augusta Rule is making sure that you're charging yourself a reasonable amount. This is where having a tax professional can come in. Your tax professional should be able to look up in your area what the cost of renting out a space or a house of your size would be, as well as what it would look like to rent out another space, such as like a hotel or a motel or any type of facility that you can conduct a business meeting. If you're looking at this video right now and you have an opportunity to implement the Augusta Rule strategy for 2022, but there's one most important thing that you need to make sure that you do. The IRS wants to make sure that you have gotten comparable rates. You need to be able to show documentation of the meetings that you had in your house in the year and be able to show comparable rates of how you were able to charge yourself rent based on the dollar amount you figured. Most of my entrepreneurs who work with me, we will go online and we will determine what it costs to rent out a hotel for the day, a ballroom for the day, another house on Airbnb for the day, so we can come up with comparable rates to rent out the house and to leverage the Augusta rule. This happens to be one of the most overlooked tax strategies by new entrepreneurs and one that can really save you money as opposed to paying in money to the IRS. All right, guys, let's jump into strategy number 4, the SEP contribution. Many self-employed individuals are unaware that they can implement a self-employed pension plan or a SEP plan as a part of their retirement strategy. One of the ways in which you can reduce your tax bill is by setting up a SEP IRA and making contributions in the year. But what happens if you set up the SEP IRA and you don't make contributions in the year? Are you still able to contribute? The answer is yes, and many business owners are actually unaware of this. If you have already taken it upon yourself to set up a self-directed solo 401k or a SEP IRA, you can leverage being able to put up to $60,000 in the SEP, receive a tax deduction for it, and then self-direct that money into whatever you wish to self-direct it into. You want to invest all the money in Apple stock, invest all the money in real estate, invest all the money in Tesla stock, you're more than welcome to do this as a self-employed individual. And you can also receive a tax deduction by simply putting money into your retirement account. One of the benefits of being a business owner is that we earn money first, we spend money second, and then we pay Uncle Sam after we calculated our deductions. If you're a business owner that's sitting on cash and you know you have a tax bill for 2022 because you're on extension, this is a way in which you can fund money into your SEP, reduce the tax bill for 2022 in the year of 2023, and still file the tax return and receive that deduction. And this is a way in which you can reduce your tax bill, and it's also an overlooked strategy by many entrepreneurs. All right, guys, let's jump into the last and probably one of the most important strategies that's overlooked. Number 5 is the real estate professional strategy. I work with so many entrepreneurs, but I also work with so many W-2 taxpayers and real estate investors. If you're a W-2 taxpayer that's a real estate investor and you have a husband or a wife that is taking the year off from work or is taking care of the children, one of the most important things that you can do is look at qualifying that spouse to be a real estate professional. All that is required is that spouse needs to spend 750 hours in the year managing the real estate portfolio that you and your husband or you and your wife have, and they need to make sure that they're just spending more time than any other person in that real estate operation. So more time than the cleaners if you're running a short-term rental business, more time than the repair people if they're coming to repair the property. But if you're able to qualify one of your spouses as a real estate professional, man, you are opening up a world full of tax deductions. The reason why is because you're able to leverage the strategy called the cost segregation study. This allows for you to accelerate depreciation on a rental property. Now, the reason why you would want to do this is because if you can turn passive losses into active losses on the return, these losses from accelerating depreciation, very similar to writing off a car in 1 year, they can create enough losses on the return to offset your W-2 taxes and maybe even your 1099 taxes. Last year, I had more than 70 W-2 taxpayers adjust their withholdings because they were proactive in doing their tax planning with me ahead of time. So we were buying investment properties, performing cost segregation studies, qualifying their wives or their husbands as real estate professionals, and we were able to use passive losses as active losses to offset their W-2 and 1099 income.
Hell to the yeah.
Some of these taxpayers were employees at big companies. They were receiving restricted stock unit. They were receiving bonuses. And the last thing that they wanted was the taxes to be withheld from them receiving the full bonus that they could have gotten paid. It's like, dude, every time we work hard, we get taxed more. Isn't there a way in which we can adjust things around and take home more of our hard-earned money? Well, if we are strategizing right now for you to be able to buy real estate, perform the cost segregation study, qualify for real estate professional strategy, or the short-term rental strategy, we have options here, then we can position ourselves to adjust our withholdings for this year, 2023. Or if we qualified as real estate professionals for last year in 2022, we can make the election on the tax return and perform a cost segregation study prior to you submitting those tax returns. Now, I'm gonna be honest with you guys. I covered 5 of the most missed tax deductions for 2022, but be smart. Get these tax strategies implemented into your prior returns if you qualify. And if you don't qualify to use some of these strategies for 2022, make sure you're working with your tax professional to get them implemented for 2023. One of the most important things that you can do as an entrepreneur or a high net W-2 taxpayer is making sure that you're learning strategies right now that you can implement prior to December 31st. If you're watching this video, I'm encouraging you to sign up for the tax-free wealth event that's going to kick off on August 1st through August 5th. During these 5 days, I'll be instructing you on how to utilize strategies like these, as well as a plethora of more strategies so you can get them implemented into your tax plan prior to December 31st. I anticipate you coming ready to learn and ready to implement strategies, not just receive information, but receive actionable steps on what you need to do to get strategies implemented. I want to say thank you so much for making it to the end of this video. If you found this video valuable, do something for me. Like, comment, subscribe, share it with somebody who you know really needs that help when it comes to their taxes. And I look forward to being your tax strategist one day. Thank you so much.